Let's talk to Ronnie Chopra. He's the Chief Market Strategist at Knightsbridge Trading Academy. Very good morning to you.
Good morning.
Ronnie. Right, the art of contrarian thinking. When you always walk in here, we've got 3 thoughts-provoking slides, a mixture of the technicals and fundamentals. Let's kick off with Barclays Bank PLC. Lots of headlines, lots of numbers, lots of fines. Is it time to buy them?
I think their results yesterday were very good, yet the market didn't really think so, because they basically changed, they closed unchanged, or a penny lower. But I think they've got a lot going for them. Their investment banking arm, which has been a cause for concern for a few years now, came out with much better than expected figures. They outperformed the 5 largest US banks, and so that kind of gives some confidence to the bank. The retail division's doing well. Profits were better than expected. They've also announced a higher dividend, so they'll be yielding approximately 3% this year, which isn't the same as the likes of Lloyd's, which is yielding 5 to 6%, but still we're increasing the dividend there. So on top of that, they should be a beneficiary of the stronger dollar at the moment, because obviously they've got big interests in the States.
Yep.
And also you have this active investor, activist, who has 5.4% of Barclays. So if Jess Steely doesn't increase profits or make the shares go up a lot higher from here, that activist investor, Bramson, is going to pull some punches and ensure that the share price does recover. They're still languishing at levels, that they're half of where they were 10 years ago,
Right.
and they've kind of underperformed the likes of Lloyd's over the last 12 to 18 months, and I think they should be playing catch up.
Okay, so you like those. Let's move on to BT. This is an absolute dog.
Well, you say that, but they've recovered about 10-15% in the last few weeks, and they still are making decent money. They're on a price-earnings ratio of 8.5, and they give a dividend yield of 6%. So they're making changes. Obviously, they had problems in Italy with that whole fraud case a couple of years ago, and that knocked the shares for 6.
2 years ago. Wow.
Yeah, it was. They were trading around £5 then, so they're half of that level now. And back in 2000, these were at 15 quid, and they were floated, I think, in 84.
It was 84.
Yeah, £1.30, 3 instalments. Remember that?
Well, I remember it. It was.
I was
the
11
down
years
payment
old.
on my mortgage.
Really? But what makes them attractive at the moment is the EE subsidiary, which they got from Deutsche Telekom in exchange for a 14% stake. And also, Deutsche Telekom will be allowed to bid for them in 2019.
Okay.
So that kind of makes them even more enticing. And with the shares languishing at this level, although they've recovered 10% or so in the last few weeks, I think they're very attractive.
So you put those on the back book as well. Okay, so let's wrap up with Sainsbury's. Obviously rallied recently on the back of the Tesco's numbers.
That's right.
A messy chart.
Well, look at that spike. That's quite a recovery again in the last few weeks, since Tesco's results out. What was that? Around 2.5 weeks ago. Sainsbury's have followed suit. There's kind of a change in sentiment. Both Sainsbury's and Tesco are up about 15% in the last couple of weeks. And just with Sainsbury's, the acquisition of Argos is going very well, and they're cutting costs. They're closing shops, so that they're paying less in rents, rates, etc. And also there's kind of a complete shift in the sector. Add to that they have a property portfolio worth well in excess of the current market cap. They were bid for by the Qataris twice. The last time being, I think it was 2011, and before that in 2006 or 7, at £6 a share. Currently they're around, the 265p mark, and throw in the whole property portfolio being worth far more than the current market cap, dividend yield of 6%. Again, another one that, even after the recent rally, very attractively priced.
You still have those on the back book. On that note, Ronnie, thank you very much indeed.